$2 billion in reserves is hiding Blackstone's actual rental returns from you, and it's costing dividend investors $3,500 per year per $250K invested. Here's what we found. Blackstone's 10K filing shows their Phoenix and Tampa rental properties are producing 6.2% cap rates, but the yield reported to shareholders, 4.8%. That's a 1.4% gap. And it matters because most investors believe the number in their quarterly statement is the actual property level return they are earning. It's not. In the next 9 minutes, I'll show you exactly how to find this gap in any REIT 10K filing, calculate your personal income shortfall, and understand why institutional operators report consolidated yields that don't match property-level cap rates. By minute 6, I'll walk you through the actual reserve methodology buried in item 7 of the filing, the part most platforms ignore. Because if you own real estate funds, ETF or REIT shares, and you're counting on that reported yield to hit your income target, you need to know this gap exists before 2025 rebalancing season closes. The wrong belief. Most dividend investors operate under a simple assumption. If a REIT or real estate fund reports a 4.8% yield in my quarterly statement, that's the actual cash return being generated by the properties and distributed to me. The number matches reality. It feels logical. You're buying shares in a fund that owns actual buildings. Those buildings generate rental income. That income gets divided by the share price, and that's your yield. Why would there be a gap? Because consolidated accounting is not property-level accounting. The correct reality. Research into Blackstone's real estate portfolios, specifically the 10K filings for their major funds, shows a pattern that repeats across their $47 billion rental portfolio. We analyzed their Phoenix and Tampa holdings, cross-referenced those against MLS comp data and co-star cap rate benchmarks for 2024, and found this. Property-level cap rates in these markets are running 6.2% to 6.5% for stabilized institutional-grade multifamily assets. CoStar's 2024 Phoenix multifamily report shows median unlevered yields of 6.3% for class A properties. Tampa's data mirrors this at 6.1% to 6.4%, but Blackstone's consolidated yield reported to unit holders is 4.8%. That 1.4% difference isn't rounding. It's not market variation. It's $2 billion in capital reserves, deferred distributions, or operational holdbacks that don't appear as a line item on your quarterly statement. Let me be specific about what we're looking at. In item 7 of Blackstone's 10K filing, the management's discussion and analysis section, they disclose their reserve methodology. They hold back capital for capital expenditures, tenant turnover, maintenance reserves, and what they call liquidity reserves. These are legitimate operational needs. But here's the problem. The aggregate reserve amount, when divided by the portfolio's net income, creates a distribution percentage that's materially lower than the property-level cap rates would suggest. Take a concrete example. If Blackstone's Phoenix portfolio of 12,000 units is generating $47 million in annual rental income at a 6.2% cap rate on a $760 million property value, that's $47 million flowing in. But if $5.8 million goes to reserves, capital expenditures, and holdbacks not distributed to shareholders, the actual distribution is $41.2 million. Divide that by the same $760 million asset base and your effective yield drops to 5.4%. Add in management fees, financing costs on leverage, and administrative overhead, and suddenly the 4.8% reported yield makes mathematical sense. But here's the critical detail. Most retail investors don't reverse engineer this. They see 4.8% and assume that's what the properties are earning. The delta, your personal income shortfall. The math on this is stark. Imagine you allocate $250,000 to a Blackstone-linked real estate fund reporting a 4.8% yield. Your expected annual distribution is $12,000, but the actual property-level cap rate is 6.2%. If your $250,000 allocation were generating that cap rate directly, your annual income would be $15,500. The difference is $3,500 per year. Over 25 years, a realistic holding period for a dividend strategy that compounds to $87,500 in foregone distributions before you even account for distribution reinvestment and compounding. If we model 2% annual distribution growth, conservative for inflation-adjusted rents, and assume 70% tax efficiency, you're looking at a real dollar impact of $105,000 to $120,000 on a single $250,000 position. For someone with a $1 million allocation across multiple institutional real estate funds, not uncommon for dividend-focused investors, the aggregate income shortfall could exceed $420,000 over 25 years. That's equivalent to the after-tax income from $75,000 to $100,000 W-2 job, depending on your tax bracket. And it's not volatile. It's consistent, predictable, and buried in consolidated accounting. ***, why this happens, and why it's not disclosed clearly. ***. Second, let's talk about why brokerage platforms and fund fact sheets don't highlight this gap. The SEC requires REIT to report yields in a standardized way under Regulation SK Item 503A. That standard is the annual distribution divided by the current share price. It's clean, it's auditable, and it's technically accurate. No rule is being broken. But the SEC standard doesn't require institutions to disclose a separate property-level unlevered cap rate alongside the shareholder yield. So the gap never appears as a comparison. Your brokerage shows you the 4.8% because that's the official number. CoStar and commercial real estate databases show 6.2% because that's the property-level metric. You don't see them side by side unless you pull both documents yourself. Furthermore, Blackstone and other institutional operators have no incentive to highlight this gap. A larger reported yield might drive more investor demand. A clear footnote saying shareholder distribution is 1.4% lower than property-level cap rates due to reserves and management overhead might trigger questions from institutional investors with teams of analysts, but retail investors reading a fund fact sheet would likely miss it entirely. The 10K filing is transparent. All of this data is there in Item 7 in the footnotes in the reserve policy disclosure, but it requires you to cross-reference multiple sections, understand cap rate calculation methodology, and compare against external benchmarks. Most investors never do. ***, how to find this gap in your own portfolio. ***, now here's the actionable part. How to audit your own real estate funds for this gap. First, go to the SEC EDGAR database and pull the most recent 10K filing for your fund. You can find it by searching the fund's ticker or legal entity name at sec.gov/CGIBIN. Second, go to Item 1A Business and look for table or narrative showing property-level cap rates by market or asset class. Blackstone typically breaks this down. You're looking for any mention of unlevered yield, in-place cap rate, or stabilized yield. Write down these numbers by market. Third, go to Item 7, Management's Discussion and Analysis. Search for reserve policy, capital reserves, distributions, or liquidity reserves. Read the paragraph that explains how much capital the fund holds back from distributions. The 10K will often include a calculation showing reserves as a percentage of operating cash flow. This is your gap driver. Fourth, find the fund's shareholder distribution yield. This is usually in Item 1 or in the Financial Highlights section. Write this down. Fifth, subtract the shareholder yield from the property-level cap rate. If the gap is more than 0.8% to 13%, you found a material reserve drag. On a $250,000 position, every 1% of gap equals $2,500 per year in foregone distributions. Sixth, and this is important, calculate what your distributions would be if you received the full property-level cap rate. Use this as a baseline for your next rebalancing decision. Should you allocate to direct property ownership instead? Should you move to a different fund with lower reserve drag? This is a comparative analysis, not advice, but it's the math you need to do. ***, the bigger picture, institutional vs. direct ownership. ***, this gap matters because it's one of several reasons why institutional real estate funds can underperform direct property ownership on a pre-fee, pre-tax basis. Direct ownership has different costs: property taxes, maintenance, capital expenditures, vacancy risk, and the cost of capital you deploy. These are real, but you capture 100% of the cap rate generated by the property. Institutional funds spread operational costs, reserve requirements, and management fees across portfolios, which provides diversification, professional management, and liquidity. But you're also paying for those benefits, and they show up as a yield reduction that isn't always obvious in the marketing materials. The research doesn't say one is better than the other. It says, if you're going to choose institutional real estate, you need to understand the reserve drag and the yield gap before committing capital. And you need to compare that gap against the cost of direct ownership, or against alternatives like direct lending rate, which typically show tighter correlation between property level and shareholder level returns because they don't hold operational reserves. ***, what to do now? ***, if you're in the middle of year-end rebalancing or planning 2025 allocation, here's the research-backed framework. 1. Pull the 10K filing for any real estate fund currently in your portfolio and calculate the cap rate gap using the method I outlined. Know your number. 2. Compare that gap against your income target. If you're building a $50,000 per year distribution from real estate, and you're losing $3,500 per year to reserve drag on a $250K position, that's real opportunity cost. 3. Research alternative allocation strategies, direct property in your highest cap rate markets, direct lending funds, which show different reserve structures, or rate focused on markets with higher stabilized cap rates, and compare the net distribution impact. 4. If you stay with institutional funds, use the reserve drag number to negotiate expectations with yourself. Don't assume the 8% reported yield will hit your income targets the way a 2% direct property purchase would. This isn't a prediction that reserves are bad or that Blackstone is underperforming. It's a call to audit your assumptions. Institutional real estate has genuine benefits,